All right, great. Welcome back. Been an eventful couple of days in the market. Powell had Jackson Hole on Friday. I think the last podcast we had, Larry and I were both, somewhat apprehensive going in. Not that we thought Powell was going to come out and be hawkish, but we thought Powell could come out and be hawkish. And you're better off being apprehensive ahead of events like that. Powell came out dovish, or at least that's how it was interpreted. Market rallied big on Friday, sold off a bit yesterday, up today. To me, at this point, this looks like a bleed up market. We've got NVIDIA earnings tomorrow, Wednesday, after the close. That could be big. We got PCE coming out. That could be big. But beyond that, it just looks like this thing wants to continue to bleed up. From where I'm interested right now is more what's going on in crypto, where Bitcoin collapsed over the weekend. Looks like a whale sold a whole bunch, and there's not as much liquidity. But it hasn't completely come back. Around 110 right now. The relative strength of Ether over Bitcoin is also interesting as well. You had Peter Thiel come out, talking about Ether. Eric Trump talks about Ether a lot. So I think that's something that, along with Bitcoin, you ought to have. So that's kind of what I'm thinking. What about you, Jeremy?
I'm in the same boat, but I did put a technical target for pullback on Bitcoin down to like 107. Probably going to see a lot of liquidity grab it there. That's why I'd assume the limit orders would be waiting. And then, yeah, the bleed up on the market in general is pretty sustained to a point. I did mention last time we were on that we saw the broadening pattern on SPY start to compress after Jackson Hole. And of course, or before Jackson Hole, and now that we've got that run on Friday, it went right to angular resistance and stopped. So the old diamond pattern strikes again. I think we're just going to be ranging around in this for a little while until we start to break it. And it's looking, man, it's looking like the first week of September we're in for something. Just the way the market's setting up on a technical analysis side. And everything else is fun though. We've been messing with PLTR still. Couple other stocks we've been trading have just been doing fine. So we just trade what we see.
So is this something to worry about? Like, I mean, the Bitcoin goes from 70 to 125 back to 110. That doesn't seem like very much. It sounds like, Matt, you think it's something to worry about.
I don't think it's something to worry about. Crypto is a strange asset class. I think it's gotten to the point where it's a must own. For me on a delta adjusted basis, it's 10 to 12% of my portfolio. But wow. I'm also doing that with options. So if it goes to zero, I don't lose 12%. I think that's important. If I were just buying like IBIT or Bitcoin or something like that, I'd say 5% of your portfolio type of deal. I think it's interesting that the factors that are impacting crypto are a lot tougher to wrap your head around than the factors that impact the market. Friday, real easy to explain in the market. Monday, yeah, you give some back. Real easy to explain, wrap your head around. And I pointed this out in the newsletter this morning. You don't really know, why did Bitcoin go down? Why is Bitcoin in a downtrend? And Barron's wrote an article like, crypto selling off, here's why. I'm like, all right, interesting. I wonder what Barron's is saying. And there was no, here's why. It's just Bitcoin is sold off. And it's because you don't really know the here's why. So no, I'm not worried about it unless it goes below like some key levels. If it goes below 100, that could be problematic. But what something like Bitcoin has shown you year after year after year is you buy the dips in it.
Got
And, until that's proven wrong, I think that's what you do.
right.
I
Okay. Go ahead, Jay.
I wanted to add, I mean, it's purely a technical chart in Bitcoin. No one can really say why anything happens in it. I mean, you got even Barron's just kind of lost for words on that. Just a
So it
bit,
trades more like a commodity than a, equity, is what you're saying,
kind of, yeah.
No,
right?
I mean,
No?
well,
no, not at all. Because commodities you can make sense of as well.
right.
Oil, I mean, all that stuff. This could, there's always a reason. It's just, can you discern the reason, for these moves? And I would argue you really can.
Right. Okay, so I'm going to go ahead and intro our guest. Yeah, we got
Sure.
Marcos Milla on. He's everywhere: YouTube, Twitter, Blossom Social. He's called the real ETF guy, right? Uh, Marcos, you made this very famous statement here that says, "I feel like selling out of SCHD, which is Schwab, for ULTY, which is YieldMax, is like cheating on your wife of 30 years for a Victoria's Secret supermodel who may or may not divorce you soon, but still can work out long term if you don't tend to the relationship." So, what did you mean by that? Because that's pretty interesting.
Yeah,
I'm just that's a good lady.
That's loaded, man.
You said it. I didn't say it. You said it.
yeah, it's a funny statement. We're seeing a huge shift in investors forego, traditional dividend ETFs for covered call ETFs, and just seeing that the shift from people selling out of SDHD, known to be a pretty solid dividend investment over the last 5 years and even since inception, seeing underperformance for 1 year, 2 years, just depending on how the market moves for a new flashy ETF like ULTY. And I've covered ULT with the YieldMax team a couple times, and I feel like when investors kind of forego a 4% yield for something that's 90% plus, they might not understand how implied volatility works, how cover calls work with an ETF like that. So I've been noticing a lot of investors just sell out of SCHD, a lot of their positions, and go into YieldMax products and go into cover calls. And to me, that's fine as long as they understand the risks of it and if it fits their goal in their portfolio. So when I made that tweet, I thought it was like the funniest thing ever, because
So did I.
you're going from something that's stable, right? Like your wife, SCHD, tend to it, it'll always be there, right? And then you go to ULT with the flashy, sexy yield, and you might not be able to. We don't
Right.
know how it's going to fare in the next 5 or 10 years, but I know that the YieldMax team is doing everything that they can to make it a long-term investment for investors.
Yeah, but you're very positive on like TSPY, just one of our products, right? You called that like your number 2 income fund out there. So what do you think about that? Or Matt, why don't you talk about that with Marcus a bit?
Well, let's hear what Marcos has to say, and then
Yeah.
I'll
Okay.
tell you where I'm coming from, because
Okay.
I've got a lot to say on covered calls, dividends, all that stuff.
Yeah, so I'm really a big bull on TSPY. I definitely like the funds that have like a more sustainable distribution, as well as more of a sustainable yield, as well as TSPY has kind of got to be the top one. I know a lot of people like Neos products like SPYI and QQQI, but TSPY is going to be coming out, or Tap Alpha is going to be coming out with TDAC. But something about TSPY that I like is the fact that you don't have as much, or even if at all, any destructive return of capital. I know that's a big topic when investors look at a chart and they look at other products that are yielding 50% to 100% yields, and they just see the share price just keep on going down, and then eventually you're going to see reverse splits, and some investors just don't understand how that stuff works. So this space is almost exploding. I know that a lot of ETF issuers are just coming out with like random products just to have a product out there for AUM. But what I like about TSPY and what I like about Saikatara, the CEO of Tap Alpha, is coming out with an innovative product that we haven't seen before since the inception of the first cover call ETF, which was QYLD, coming out and having a very unique ETF that investors now we're seeing more AUM coming into it. I think I was covering it when it was at like 25 million AUM, and now it's at over 60.
Yep.
And investors just like the growth of it, the distribution, monthly income, and seeing stable, I guess, like appreciation with the underlying being the SPY or the S&P 500. And overall, a lot of investors just like TSPY, just everything about it. And I think it's one of the ETFs that for the next decade from now, it's going to be one we're going to be talking about, and one that a lot of other ETF issuers are going to be keeping an eye on for sure.
Yeah, so I'll give you my sense on the whole space, and I could go for hours. I'm going to keep it as brief as I can.
Thank you.
So
Yeah.
yeah, you're welcome. So I am not a big fan of investing for income. I think you invest to make money. And whether that comes from dividends, interest, option premiums, capital gains, money is money. And when you are purely focused on trying to invest for income, you can miss a lot. Like, buying an SCHD or a DVY or, whatever. There are a whole bunch of thematic investments that you're going to miss because those companies don't pay dividends. I'm not a fan of covered call ETFs because I think you give up, a good chunk of the upside and you're not really limiting your downside. The caveat to that is I think zero DTE is the exception because every night you're unencumbered. And studies show that the majority of returns on the markets come overnight. And, even then, someone doing a zero DTE, and I believe Cy did this on Friday. I'm not 100% sure, but I believe he did. He waited for Powell. And then and then you write your call. So you've got a lot of flexibility there on a zero DTE. But beyond that, I'm not a fan of covered calls. We're going to be filing a slew of ETFs, in the option income space on themes that I think people should be invested in, stocks that people like that are also in those themes, but we're going to be using puts. And the idea really came out of, I love writing cash secured puts. There are a lot of reasons why that I don't need to get into on this. But it really came from the idea of the risk reversal option trade where you're buying a call and writing a put. That could be a credit, it could be premium neutral. But, basically, let's say you're getting a credit for it. And if you're right and the stock goes up, you've got unlimited upside and you got paid to put on that trade. I love that idea. So that's kind of where I'm coming from. So why to me TSPY is the exception. And we're also going to be coming out in September with a series of zero DTE options on single names. Because again, I think that's an exception. So that's just where I come out on all that.
Yeah. What about Cy though? Where's he the exception? Why do you like him?
Because it's zero DTE.
Got it.
So you're not capping your overnight gains. So the only time Cy runs into trouble, and he did, is like the day that Trump tweets, during the trading day out of the blue, buy stocks, and the market goes up 10%. Cy had already written his options for the day. He got his butt kicked that day. But, anybody who was doing a covered call ETF got their butt kicked that day. And that's the exception, not the rule.
Got it. And then what would YieldMax be doing that's different that you don't like it per se?
They're selling covered calls. And when you sell a covered call, you are giving up some of your upside. Now, the other issue too that I forgot that Marcos mentioned that's important is return of principal. So the yields on these ETFs are kind of the shiny object. What people don't realize is that, I could deliver you entirely return of your own money and call it yield, and people don't watch the share price. So Cy is out there, to his credit, educating people on this, because Cy's yield is not a shiny object. It's like somewhere near 15%, which compared to like, in Alti, I mean, Marco said 90%. It's not even close. What Cy is saying is, look, I'm going to do this the right way. I'm not returning your principal. I'm going to get, we're going to make money from selling calls. I'm going to give you that, but I'm not giving you anything else.
All right.
The objective
Anything
is
to add
make
on that,
money.
Marcos? Oh, Jay, go ahead. Anything to add,
The
Jay?
objective for SI is to make money together instead of, just making money off of your investors. Pretty simple.
Anything to add, Marcos?
Yeah, I mean, the thing I like about TSPY is that you can make it, I guess, a core position. I know personally, I don't own any cover call ETFs. I mean, I'm definitely a big fan of long-term growth, and I don't want to cap my upside. And a lot of investors don't know that you carry like pretty much all the downside in a cover call strategy. With these ETFs, if you have an implied volatility of 90, you could get that on the upside, but you could also get that on the downside. And personally, when this whole space exploded, I knew that investors should be educated. So I started reaching out to ETF issuers and CEOs and having them hopefully come on and just break down an ETF in like a full hour. And some other people are doing it now, but I think what makes me different is I do a lot of research before, a lot of editing after. So people, when they hear Cy speak about, zero dated options and how that stuff works, I do like a whole B-roll of like explaining it and how it works with like visuals so people can learn. But I think with TSPY, I do like the fact that you can capture, overnight growth. I like what Matthew said with the fact that, most of the gains comes overnight. And with zero data options, you could kind of track the underlying a little bit more better than anybody else who's like writing the call options over 30 days. So I think that's what makes SI unique, but also as well as I know Neos does this with their, they classify some of the options as like section like 1256 contracts. So you get like a little bit better tax break than other funds, but overall, I think TSPY is going to be one that, like I said before, it's going to be one to watch out for the next 5 or 10 years.
I think the education piece is huge. So for example, I know Pat has no idea what zero DTE means, but he's pretending like he does. And also, those yields are such a shiny object that people need to really understand, what it is they're getting. And, and I do from time to time also hear, oh, I'm protected on the downside. Well, only as much, as the premium from writing the options, but, they're not doing this on Procter and Gamble. They're doing this on MicroStrategy that can and does have 50% drawdowns from time to time. You get 5% on an option premium, you're still looking at a 45% drawdown. It doesn't, it's a drop in the bucket on these names. So I think the education piece is huge, and not just getting, laser focused on the shiny object, which is the yield.
So I was going to say that Marcus, you edit, right? If we edited this podcast, these guys would edit me out, just so you know. So that's number one. Number two.
Well, yeah, I mean, if we had,
so we don't edit. I don't let these guys
wouldn't
edit.
be involved at all. But yeah.
So, number one. Number two, though. So let's say I'm devil's advocate. Let's say I'm the YieldMax guy on here, right? Saying, oh, yeah, Matt's full of shit, whatever. What would he say? Like, what would his comeback be? Yeah. So what? You get all your money back. What's wrong with that? Is is there any, realistic argument against what you're saying, Matt? You'd say no, yes?
Well, let Marcus go, and then I'll.
Yeah. I mean, to my knowledge, like this whole space it's exploding. So I know with like return of capital, it's more of like a tax classification for purposes of for taxes. Because I know that when YieldMax and some of these products, like if the underlying just explodes up in price, they can't make it all return of capital. So I think last year when this happened with MicroStrategy, I think 100% of the distributions was like ordinary income. So you're just gonna get smacked in the face on the tax break. But it's definitely a topic where investors are getting more educated. I'm getting more educated. On Friday, actually, me and Cy are gonna go over his, he had an article out about just destructive return of capital. And we're gonna like go over like how it works and whatnot, and hopefully educate a lot of people. But yeah, I know that with some ETF issuers that they have different goals. So like YieldMax, it's like they're gonna give you as much distribution as possible, like YieldMax. And then you have like
Got it.
other issuers that don't want to distribute as much. They probably earn more than they just distribute out, and they could just like use that premium to like invest in other positions than their underlying if they do wish to do so. Some ETF issuers have targets, which is like I know Vista Shares has like target 15, so they target like a 15% yield. But investors just honestly want like transparency, consistency with their distributions. Like TSPY does that. Like every single month, you see like a pretty consistent distribution, but they just want like transparency, honesty, and education. And everybody can pick their own poison, whether they want
Right.
this
coming.
product or this product. And I think right now there's the biggest topic of investors wanting cover call ETFs. And I get it, right? The yield, some ETF issuers, you go on the website, the first thing you see is the yield. You don't see the performance. You don't see the total return. And that's fine. Everybody has their own marketing strategy. But I just wish that maybe some investors like knew that you shouldn't do cover calls on like most of your portfolio, especially if you're young. And I'm seeing even on Blossom, I'm seeing all these young people have their whole portfolio in cover call ETFs, and not the ones like TSPY, ones that are like 50 to 100% yields. And people just truly believe that they could get a 30% yield and at no underlying NAV decay. And they just think, okay, I'm gonna get 30% yield year over year. I'm gonna beat Warren Buffett. It's not how it works.
Yeah, so covered calls, that's
I'm okay with people doing that. I'm okay. I'm not okay. Yeah.
With people being led to believe that they're actually gaining something other than their own money back.
So my question to you again, Matt, is like, so what's wrong with that? So you get
Yeah, all right.
27% yield. What's wrong with that? That's great. I get 27% back every day. That's awesome. Or month, year, whatever. Yeah.
Yeah, so covered calls have been a strategy that's been around for a long time. And traditionally, it's been used by, more conservative investors who have a portfolio of stocks that don't move a lot, that they're writing calls on top of. So, if I've got, Procter and Gamble and Clorox and McDonald's and Coca-Cola, those are stocks that aren't zooming up. So, if I'm going to have a portfolio of stocks like that, and I say, you know what, I'm going to write calls against them and I'm going to earn some income, I got no problem with that. And, and I'd also probably look at it and be like, you know what, that probably is a pretty smart strategy if those are the names you're going to hold. What these issuers have done is said, well, forget about Procter and Gamble. We're taking MicroStrategy and Coinbase and these volatile stocks that have options that are way more expensive. We're going to do the exact same strategy, but we're going to earn you a bunch more yield. But the problem is, again, you're giving up a lot of your upside, in those. And, you look at the traditional covered call buyer, they're not buying, or they shouldn't be buying Coinbase and MicroStrategy and all those. But then you look, as Marco said, the younger guy with a long time horizon, you're giving up your upside, in those names. That's the problem. So for me, covered calls is something I would occasionally do. If I owned a stock and, for whatever reason, I didn't want to sell it. And, my sense is, what, the market's likely to be flat right now. Sure, I'll write a call against it. I hardly ever do that. Occasionally I'll do that on SPY. I run a 0 DTE. I've said before, SPY strategy using puts. Occasionally I'll get assigned and I'll be long SPY, and I'll be sitting there like, yeah, I'll have a put against it, so I'm totally hedged. So you know what? Why not? I'll write a call, earn a little bit of income. Maybe the SPY gets that gets called away, it's fine. I don't mind it getting called away. I'll earn a little bit of income. But, beyond that, again, I look at these as shiny objects, and I'm not sure the use case. But then on the flip side, if you do it with puts, I like that, because
Right.
now you've got unlimited upside. You're earning income on the puts. You're going to have a little more downside, which, if you think the stock is going up and you're right, you don't care about. But, you've got to be cognizant of that. That's the type of thing that I think makes a whole lot more sense.
And what you say about the zero DTE is it's going to expire at the close. Therefore, if some news comes out after the market and it gaps up 5, you still catch that move or whatever.
Right. And also you've got the ability to, like, I don't remember when Powell's speech got disseminated, but I think it was around 10 a.m. So you've got the ability to be like, all right, I'm going to sit. I'm going to wait. All right, market going up. I'm going to put my call, up higher. Everyone's going to get killed if Trump tweets midday buy stocks and they go up 10%. But, if you're going to do it, I would do it zero DTE.
Got it.
And we'll have a slew of those products end of September.
Jay, anything to add? Because I'm going to move on to something else with Marcos. Yeah.
Yeah, I mean, just a quick agreement. I mean, the put side's better. I do both, but I run a modified version of the wheel trade strategy to do it. So like I'm only core positions long half, selling puts for another half possible. Also selling covered calls only when I've been assigned on a put. So if I've doubled my position, I'm going to get rid of half of it with a covered call should it get assigned. So it's just it modifies things a bit. So I can be on both sides. I mean, one side would be like, okay, I'd rather sell puts than covered calls, but I like to do both because they can't both expire in the money.
Jeremy, we modeled out, I don't know if I told you, I modeled out the wheel strategy we were talking about. Without return of principal, we're looking at the potential of 200% yields on that.
Yep. That's about tracks. That's kind of
yeah. So we're doing the wheel also.
So who's the bright shiny object now, man? That's what I want to know.
Well, but we're doing that with puts.
Okay.
We're not doing that with covered calls.
As long as our bright shiny object, right? That's fine. Now, all right. So Marcos,
our bright shiny objects are going to also make investment sense.
all right,
Yes.
Marcos. All right, moving on. Right. So we had a guest on a while back. His name was Mr. Cash, Dan Cash. He talks about like passive income, kind of new age stuff. So it kind of got us all, me thinking anyway, about like that topic matter. Then we kind of, well, Matt introduced me to you or told me to check you out. So I kind of did some homework on you. You talk about passive income, and it seems like, your audience is in the youngish group. Like we're all old, right? I'm the youngest of the three, but we're all old. And, it seems like there's a whole like group of young kind of income investors in their 20s and 30s, right? Is that true? Is that fair? And why do you think that is? Because I've tried to explain that to people before, and I and I have a son too, who's about your age, so I get it. He's a nice kid. I just can't really explain it. Is there any thoughts? Do you have any thoughts on that?
Yeah, I definitely have I'd say my audience is about like 35 to 40 years old.
Yeah.
That's kind of like the analytics I'm seeing. But I'm 24 and my portfolio is purely growth. I don't have any covered call ETFs. And I feel like we're seeing a lot of young investors, go into passive income investing and mainly through covered call ETFs. I'd say last year it was mostly like SCHD, DGRO, like those like traditional dividend ETFs. And now we're seeing everybody pile into anything that has a yield about 10 to it could go up to 100% yield. So we're definitely seeing a lot of investors just pile into covered call ETFs, and I'm still trying to wrap my head around why, because you'll get the best return possible if you don't write call options on your underlying. But I definitely see we're seeing a huge shift. Everybody on the YouTube space, as well as even like ETF issuers that from people I know that work at these big companies, they're seeing a huge shift in AUM piling into these covered call products.
Exactly.
But
it used to just be for little old ladies, or whatever. Now it feels like there's been a shift. I don't know.
Yeah, Yeah, there's been a huge shift, but I definitely do see everybody at least owning a cover call ETF in the next like 5 or 10 years. Me personally, no, but I'm definitely a big fan of like S&P 500, Nasdaq 100, some other products that are purely like growth ETFs. It's kind of like my
Everyone's going to be owning products with put spreads,
yeah,
not covered calls.
yeah.
Right.
Yep.
If I have anything to say about it, that is.
Yeah,
Right.
there's definitely a couple more people like noticing. I know there's another ETF that does put spreads instead of calls on it, and yeah, you're seeing like the underlying like the share price just going up and up and up. You might see a little less premium and a lower yield, but you're seeing like a better chart per se. And I know that's what the CEO said. Like, hey, like I want to do put spreads to have like the unlimited not unlimited, but better upside potential than the ones that just do call spreads. So that's going to be a new shift, and that's something that I don't see a lot of ETF companies do. So if the cover call products that Tuttle launches are put spreads, then shoot, I think that's going to be a successful product.
Right.
I hope so.
Agreed.
Yeah,
I
I
mean,
keep. Go
it's
ahead.
it's yield. It may be a tiny bit less than the shiny object that a lot of other marketing teams seem to put out there, but in the long run,
It may not be. Remember, puts
right? If it's
tend to be more expensive than calls because people are more scared of the downside than they are greedy about the upside.
exactly, and the spreads can also capture different width too. So it makes sense. But the best part of all is that the yield does not touch the NAV, which is all anybody could ask for.
Well,
Right.
but remember that's an issuer decision
Right.
whether you want to return principal or not. But I also think it's a business decision. So and I have no idea. I mean, this would be an interesting question for Cy and I think Cy gives income monthly, so it's a non-issue monthly. A lot of these weekly products, what do you do if you don't have any option premium that week because you got assigned and you actually took a loss?
Right.
Do you return principal? And I think the answer is for that week you do, just because the business ramifications of skipping a dividend are not going to be good. So
Good point.
I think there's two, there are the guys who are consistently returning principal to juice their reported yield. And then you've got the guys who would only return principal if they had to. And we had that conversation around our zero DTE stuff. And, my technical, ex hedge fund guy is like, oh, we won't do a dividend that week. Like, that's probably the right answer, but from a business standpoint,
Right.
we can't do that. So
Right.
we're going to have to return principal. If we have a week where we just get our butt kicked on the options and we don't have any premium income to distribute.
That's the part of my personal strategy that I almost forget about sometimes. Sometimes I'm not selling options in a week because I'm waiting for prices to rearrange. So that does make sense. I get to skip a dividend for myself, but
Well, right.
in a
When
fund,
it's you, that's one thing. But when you're in competition and people are expecting, a weekly dividend, skipping that week, again, that may be the right answer. Hey guys, we had a couple of days where intraday the underlying zoomed up and went through, our strike, and we ended up taking a loss.
right.
And that sucked up all our premium income. I don't know that we're in a marketplace where you can get away with that right now.
Right. Huh.
Good point.
Wow. We got a real ETF guy talking real business strategy here. It's some pretty good stuff. All right, moving on. So, let's talk about like entrepreneurial income strategies. I just made that term up, right? So we have a partner, Rec Shares. I think they have a Solana staking thing out there that seems to be doing great. I don't know. Like, And are you excited, Marcus, have any thoughts on like any other like income strategies, whatever, staking or any other thoughts like, future ETF ideas?
Yeah, I've never dove much into like staking or any sort of like crypto staking.
Right.
I think for myself on my channel, just mainly focus on like actual dividends, and then we got cover calls and generating premiums that way. But to my knowledge, I think that's like the only two things I pretty much focus on, at least giving education on the channel. But I'm always open to any new avenue as long as I got to vent it out first and then give some insights to people if they want, if they choose to like request it. So, covered first of all, I covered like this ticker and then this ticker, and then people always request like, hey, like, why don't you talk about this ticker? So I try to, reach out to the CEO or the founder and see if they could hop on the channel and talk about it. But for now, at least it's cover calls and dividends.
Pat, staking is not even in the first inning yet. The rules are unclear. And Rex was able to get around some things in their Solana. Ether is an issue. People are talking about maybe getting revenue rulings. We're not even in the first innings, but at some point in the future, that's going to be a huge area. Just the regulations have not caught up with the innovation yet on the crypto side.
Right. So, I mean, do you have any like other thoughts like that, Matt, like that what you're looking at, 2 years down the road, 3 years down the road, like, oh, this is the skunk works idea, anything like that?
Well, if I did, I wouldn't give it
Right.
in public.
Fair enough.
But the
How about some bad ones,
innovation.
like some traps, like double secret, double agent stuff?
I'll give you the stuff I know isn't going to work.
Yeah,
There's
please.
going to be tremendous innovation in crypto. At some point, the regulations will catch up. There's a project there's a bunch of crypto projects we're working on, in partnership with a few big groups. And then there's also something I'm working on myself that if it works, and it's a big if, it's one of those things you hear the idea and it's either the most brilliant idea you've ever heard or completely and totally stupid. And I
Right.
haven't decided which, but if it works, it could be a game changer. So stay tuned. We will see.
Right. Well, I could have said that actually. All right. So, I got another question for you. Marcus, how do you balance between high dividend ETF allocations and growth focused products like S&P 500, et cetera?
I'd say you gotta have more growth than than high dividends, but in terms of like balancing in between it, it's definitely depends on your goals. Some people want more dividends, traditional dividends, like SCHD and dividend growth stocks, and then you could go with cover call ETFs and then kind of allocate more towards that than less towards growth. But I'd say for myself and for other people, if you want more upside, then you just balance more to growth. And if you want more income now, because when you go on the website, it says like the investment objective is to see current income right now, then you just allocate more towards those high dividends or distribution ETFs than growth. But I'm definitely a huge fan of like ETFs where their primary objective is to see capital appreciation first as like the only objective. And then the secondary objective is, current income. But it just depends on someone's goals and what they actually want. So hopefully people, if they want growth, then they can allocate more to that. And if you want income
Right.
now, then you can allocate more to income now.
So what
Yeah,
would you do,
I
Matt?
100% agree. Just because a stock pays a dividend does not make it a good stock. And again, if your focus is entirely on dividends, you're going to miss out on all of the themes we talk about in this podcast, because it is rare that a stock we mention in the podcast or in my daily newsletter pays a dividend, because all of those companies are taking every cent they make and putting it back into their own growth. So I think investing for dividends means you're going to miss out on a lot. I
But
would
if you
be
told me,
investing for capital appreciation.
if you told me that I could get like a 14%, return with no return of principal, why would I ever want to do anything else?
Because what if that's your cap?
Yep.
I mean, what's wrong with that? I think I'd settle for that
but
forever.
also
You know what I
you're
mean?
not, again, return is a bunch of different components. So if you're looking at, say, a TSPY and you're saying, hey, I'm going to get, all the upside of SPY or most of the upside of SPY, and I'm going to get 14%. If I were a SPY investor, I could argue TSPY is, something I would rather do. Remember, though, you've got all the downside. So in a 2008 scenario, all right, maybe you don't lose 60%, maybe you lose 50, but you're still getting your ass kicked. So,
Right.
the gain you're getting from selling the options is only one piece of the puzzle. You've also
Right.
got capital appreciation or capital depreciation. And if anyone comes to you and says, hey, I'll give you 14% yield with no downside in an environment where T-bills are paying 4%, that's a scam.
Right. Okay. All right.
I want to throw in something too. Is
Please.
we're seeing a lot of investors invest in these high yield products, and then they post on X, on Blossom. They're like, okay, I'm making $300,000 a year in dividends, right? But their portfolio is like 600,000. If you told me that I can make $300,000 a year in dividends or in distributions with a $600,000 portfolio, I'd do it. But people have to know like the risks of it, how it works, and that you can't rely on distributions like that because sometimes it all depends on the implied volatility. We're seeing a lot of these products where you're running calls on MicroStrategy. 2 years ago the implied volatility was super high, and then we're seeing like crypto become more, I guess, of a less volatile asset. So we're seeing like the volatility drop, and then the distributions drop more and more and more and more. So then people expect like what was the high distributions to like continue, but then people don't know like the downside too. So you have all the downside. So I'm pretty sure in a big stock market crash, you're going to see portfolios just get crushed because the higher yield you chase, the more risk you take on, and then the more implied volatility that you have. So it's just a whole space that every day, like that's my big worry is what if I didn't cover this ETF? And every video I put so much pressure on myself to be perfect, because every ETF interview I go into, I want to make sure I cover everything from the benefits, the risks of it, explaining how it works. So when people just click on a video with TSPY, for example, there's a reason why I think with 2 videos with Sai Katara, it's the most viewed videos about TSPY, because I generally feel like I asked all the right questions and people
Right.
that
No, it was
video
good.
and then
They were
stop
good.
watching it.
I
So-
watched it. So, Matt, I'm going to ask you a question, and this is a serious question. So, if let's say you have this a covered call, or and you're long all these stocks and short these calls, or for puts even, and there's get redemptions throughout the day. Do you kind of have to start like unwinding the option position? Are you able to see all that, or how does that work? I mean,
Yeah, I mean, the way we would do it, and I would assume other issuers would do it similarly, is we would cut off creates and redeems at 3. So by 3 o'clock, we know what we're dealing with, and then we just plan accordingly. If you've got redemptions, well, you don't want to have naked short calls, so you'd have to cover some of your calls. And if you have money coming in creates, then you'd have to sell some calls against those. But we same thing we do on our swap ETFs. We leave us an hour to to kind of get through that. And with that, actually, I need to go. I'm going to be on Newsmax in a couple minutes talking about crypto.
okay.
So Marcos, great meeting you. You guys kind of handle it from here. Jeremy, keep Pat in check.
Got it. Yeah, I'm gonna inject a few things too in a moment.
Okay, go for it. Yeah. See you, Matt.
Let
Bye.
me
Hey, Jay.
first and foremost, let me adjust the screen really quick here, guys. Sorry. Working with OBS, it's open source, great program, but let me me size it appropriately here. Hold on one second.
So Jeremy, are you gonna be able to pull up a screen so we can get like some Marcos's stuff up here?
Yeah. Actually, Marcos should be able to share a screen if you wanted to share anything. If not, I can just go in and grab a
Can you
chart.
share, or Marcos, if you want to, why don't you share? Let's see.
Got to put him on the spot now.
No, let's just see. I mean, I can do it. I didn't know that. I've never really do it. So let's see. Share.
Ah,
I don't want to do it.
I wasn't prepared for Matt to have to take off. Sorry, guys.
No worries.
So, all right. So, Marcos, anything else you want to? Okay, so I'm going to just keep going. So, Marcos, I was going to ask for this next question. You
That's all right.
posted something here about like this thing called the Title Trust 2, 100% Bitcoin, 100% gold ETF. We have a similar product. Like we have a Bitcoin and gold and Ether product. I mean, do you do anything with gold in your own portfolio, or any thoughts on gold, et cetera, et cetera?
Yeah, so I'm definitely going to add that ETF. It's called BTGD.
Yep.
It's super interesting on how we're seeing ETFs innovate with new ideas. So I think that product, I think it's by Quantify Funds, a super unique product. You're kind of stacking 100% exposure to both Bitcoin and gold, and then they do it
There we go.
through. I believe that they do it through swaps. So
Right.
that's a unique product. Definitely one I want to add. But the thing I don't like about Vanguard is Vanguard doesn't let you invest in like leverage products. So with that one, I have to like open up a separate account with like Fidelity or Schwab.
All right.
I'm a big fan of like the big brokers, and I got to open it up and do it. So
You're
that's
not
what
a
I like.
fan?
I'm sorry.
You're not a fan?
I'm not a fan of Vanguard not allowing leverage products because
What
I
did you
get
say
it.
about the big brokers? I didn't catch. You are?
Oh, no, I'm a big fan of the big
Oh,
brokers
I
for
see.
sure.
Okay, good.
Big
Okay.
fan. I know we're seeing
Okay.
like Robinhood come up too with how they're trying to get a lot of their more wealthier clients on the platform.
Right.
But I think it's super interesting with like Bitcoin like being warranted in a portfolio if you are long term and want growth. So that's one thing that I never invested in was Bitcoin. But the more I talk to these like CEOs and kind of learn more about it, I feel like a small allocation to Bitcoin, whether it be like 3 to 5%, is warranted in a long-term growth portfolio. And the fact that with that ETF, you also get exposure to gold, I think is super unique too. Just in
Are you
case.
seeing that, Jay?
Yep. I had to. Yeah, I got your screen. Now I got to adjust again.
Well,
Surprise.
this is our guy Marcos here on Velocity.
Yeah.
So, you know, he's also has a YouTube channel. We'll put that up in a sec. All right. Let me see. What else do I have here? Okay, hold on. Jay, you have anything?
I did. So one of the things that I realized, because I'm like kind of, I put together a plan for when I decided to go in and take a traditional strategy like the original wheel where you just sell one and then the other and rinse and repeat. Sometimes I'm selling both covered calls and covered puts. The thing that is hard to gauge or hard to teach is when do you have another option where you can buy to close a contract and then roll it to a later date. So when I look at that in retrospect, it does affect the amount of income that strategy generates considerably. Sometimes, you know, I'm yielding really well for premium income. Sometimes it's okay. But from the get-go, the first thing I do is I look for something that has enough options premium to where it's for me, it's got to be like if I were to sell a monthly expiration covered call or a covered put, it's got to be a certain percentage of the total outlay of cash for me to even be interested in it. So a lot of my focus ended up on being on stuff that was a little more volatile, so it would generate higher premium yields, and that gets you into a bit more risk. However, my focus is not genuinely just on income. It's how fast can I own this equity or ETF for free? So essentially, I take the premium that I've made as I'm generating it, journal everything, and then count that as a reduction in my cost basis on outlay. So eventually, if I have something that I own for free, then the income just keeps on rolling out. So I keep the strategy going, and I take a sigh of relief. I can go closer or further from the money, whichever way I decide, and take a lot of the risk off the table. But initially, my style gets me into a lot higher risk. Run that as an ETF, it's going to be really hard to market. So you have to find something with a little bit more stability, obviously. So it comes into either, you go for the blue chips or you stick to the Mag 7 or whatever it may be, or other ETFs. So it's gonna be fun to watch the products that are coming out, and I'm stoked. I'm excited to see them.
Yeah. So Marcus, just so you get it, so Jay like takes a long-term position in certain names and kind of sells calls and sells puts and uses the proceeds from that income to reinvest back into the fund, ETF, whatever. That's what he calls the quote unquote wheel strategy, right? You follow? Yeah, I hope so. Yeah.
It's modified.
All right. So last thing here, guys. So Marcus, tell us if anything else to say, anything to our listeners, your viewers, thoughts, insights, ideas.
Yeah. So first of all, I'm super happy to be here and super grateful
Thank
to be
you.
here.
No, thank you for coming.
Yeah, totally. It was funny because I started the channel in college. It was like a project to like make your own business. And so everybody was doing, these imaginary tech companies that were never going to exist or solving cancer.
Right.
So I had the channel as an idea, and I remember telling my professor, like shaking his hand, like, "Hey, this is my idea. I'm gonna
Right.
make money doing this." And I remember going to class, like investment banking classes and classes on like investing, and I wouldn't pay attention to it because I kind of know how it works, and I would just be practicing editing like all day and night. Eventually, doing this pretty much like full time now. I also have a job too full time, so I probably work like 100 hours a week.
All right.
But this is like super fun to me, is to talk about ETFs and everything from.
What's your real job?
I work.
I looked.
I don't know if I can say much about it.
You don't have to if you're
Alright.
not comfortable. We understand.
Right.
I work in like the exam world as an examiner.
There you go.
Oh, I see.
So
Gotcha.
yeah,
Okay.
I don't know if I could say the exact,
Oh,
firm
got
and
it.
stuff like that.
Okay.
Keep,
All right.
keep,
what I do
keep your
right
secret,
now.
Pat.
All right.
Yeah.
All right. Okay. Well, dude, great having you on. Appreciate it. Thank you. Anything else to add, Jay?
No, I think we've got kind of something to reflect on. I definitely would love to have you on again, because there's lots of other topics to get to
Yeah.
in the details and the background on this. Plus, I've been kind of catching up on your channel a bit, and I was saying it before the call or before we got online here, and I apologize for making this look like a recorded Zoom call. All of a sudden, I had to edit really fast. But at any rate, I mean, I love helping other people understand complex things or simple things. For the longest time, I've been with the bullish bears, educating the community on how to analyze price action, how to operate in option strategies, how they work, all that stuff. So it's really, really enlightening to run into people who are have a passion for educating and showing other people how to do stuff. It's really gets me, man. Thank you.
Yeah. All right. All right, Marcos. See you guys. Have a good day.
See ya.
Adios, Jay.
Thanks again for joining us, everybody. We'll see you we'll see you tomorrow.
Yep.
Bye.